America is standing on the edge of a financial trigger that almost no one sees. While headlines distract the public, the U.S. quietly crossed $38 trillion in national debt. Bank reserves have fallen to their lowest levels since 2019, and the Federal Reserve has just stopped the three-year process of shrinking the money supply. This single decision is the first crack in a system already strained by soaring deficits, weakening job numbers, and inflation that never fully retreated. And when a system this large can no longer tighten, it only has one path left: a reset of the money you use every single day. The most alarming shift in America's financial system didn't come with a siren. It came with silence. After extracting nearly $1.5 trillion from the economy since 2022, the Federal Reserve has abruptly halted quantitative tightening. For 3 years, the Fed was draining liquidity to cool inflation. Now that process is frozen, and the reason is far more troubling than anything visible in the headlines. The system is running out of room to contract without breaking something critical. Bank reserves, once safely above $4 trillion, have fallen toward levels historically associated with market dysfunction. Stress signals have begun emerging in short-term funding markets, where even minor liquidity shortages can spiral into full-scale credit freezes. When QT stops suddenly, it's an unmistakable sign that the financial plumbing underneath the economy has become too strained to continue absorbing the pressure. The Fed didn't pause because conditions improved. It paused because the risk of tightening further has become destabilizing. At the same time, the U.S. government is issuing debt at a scale never seen before, pushing the national total to $38 trillion and adding more than $1 trillion in new treasuries every few months. QT pulls liquidity out. Treasury issuance consumes liquidity. Combine the two long enough, and the system starts suffocating. The halt to QT confirms that this collision point has arrived. Additional tightening could have triggered severe funding shortages, forced asset sell-offs, or destabilized smaller banks already struggling with higher rates. This decision marks the beginning of a new phase, one where the Fed must hold the line and prevent the system from dipping into dangerous liquidity territory. A frozen balance sheet becomes the bridge between a shrinking monetary base and a future where expansion may be the only tool left to keep markets functioning. What comes next is not random, not optional, and not distant. Ending QT is the first move in a sequence that will reshape the value of the dollar, the cost of debt, and the trajectory of every asset in America. Once QT stops, the next phase of the cycle moves toward expansion, and that expansion is powered by a mechanism most Americans still misunderstand. Quantitative easing isn't a slogan or a policy preference. It is the literal creation of new financial fuel. Unlike taxes, revenue, or borrowing, QE manufactures dollars by altering the structure of the Federal Reserve's balance sheet. And when this engine turns on, the economy doesn't just get stimulated, it gets reprogrammed. Here is the core process. When the Fed decides to inject liquidity, it purchases U.S. Treasuries or mortgage-backed securities from major financial institutions. These transactions aren't paid for with pre-existing cash. They're paid for with newly issued digital reserves created instantly inside the Fed's system. No printing presses, no physical bills, no congressional approval. A balance sheet entry expands on the Fed's side, and the banking system receives fresh reserves that didn't exist a second earlier. During the 2020 to 2021 period, this mechanism expanded the Fed's balance sheet by over $4.5 trillion, pushing total assets above $8 trillion, the fastest monetary expansion in modern history. These newly created reserves transform into usable economic fuel through the banking sector. When banks receive this liquidity, their capacity to extend credit multiplies. Loans for housing, corporate financing, government debt absorption, and market speculation all expand because banks now possess the collateral power to initiate new lending. QE does not simply add money, it amplifies the entire credit system. The more reserves banks hold, the more aggressively financial markets can operate. This is why asset prices surge long before consumer prices respond. This mechanism links directly to the previous section. Halting QT places the system at a threshold where liquidity must eventually expand again. QT shrinks reserves. QE rebuilds them. With national debt surpassing $38 trillion and the government issuing record volumes of treasuries, the marketplace increasingly depends on the Fed's ability to create demand via its own balance sheet. As soon as liquidity conditions tighten too far, quantitative easing becomes the only tool capable of stabilizing the structure. Understanding QE means understanding the reset itself. Every cycle of manufactured liquidity alters the value of the dollar, inflates asset markets, and restructures who gains and who loses. It is not a temporary intervention. It is the engine that powers every modern boom and every modern distortion inside the U.S. financial system. To understand why the end of QT and the mechanics of QE matter now, you only need to look at the most recent cycle where the system relied on manufactured liquidity, the pandemic era. This period wasn't just an economic emergency. It was a controlled monetary reset that reshaped the value of the dollar without a single formal announcement. The blueprint created during 2020 to 2021 now serves as the model for what could emerge again, only with far greater structural risk. During that 2-year window, the Federal Reserve expanded its balance sheet by more than $4.5 trillion, taking total assets to unprecedented heights above $8 trillion. At the same time, the U.S. government issued stimulus programs totaling several trillion dollars, with cash distributed directly into consumer accounts. Low interest rates, near-zero borrowing costs, and explosive credit availability all converged into one outcome. The economy experienced one of the largest monetary injections in American history, delivered in the shortest period ever recorded. But this rapid expansion came with a hidden cost. As newly created dollars circulated through banks, markets, and consumer spending, the purchasing power of the currency deteriorated rapidly. By mid-2022, headline inflation surged to 9.1%, the highest reading in 4 decades. The reset had already taken place long before most households recognized what was happening. Their wages lagged behind rising prices, savings lost real value, and the cost of living rose in ways no temporary rate hike could reverse. This period demonstrated a crucial connection to the earlier sections. When the Fed manufactures liquidity at scale, the effects are not simply economic, they're structural. Asset markets inflate, debt becomes cheaper in nominal terms, and every dollar in circulation loses a portion of its real value. The blueprint proved that once liquidity begins flowing, reversing the consequences becomes nearly impossible without inflicting collateral damage on the broader system. The pandemic era was not an anomaly, it was a preview. It revealed how quickly the monetary system can be reset when circumstances force the Fed to act aggressively. And with the balance sheet now frozen and liquidity pressures building again, the conditions that led to that reset are quietly reappearing beneath the surface. With the blueprint of the last monetary reset still imprinted on the system, the Federal Reserve now faces a new trap, one created by rising economic weakness colliding with the lingering effects of aggressive tightening. The December meeting is not just another policy update, it is the first major test of how much pressure the financial system can withstand before the Fed is forced to pivot. Every metric that once justified raising rates is now weakening, yet inflation remains too elevated for the Fed to ease without consequences. Unemployment has climbed to 4.4%, the highest level since the tightening cycle began. Job openings have fallen by nearly 30% from their peak. Hiring momentum has slowed, and layoffs are increasing across multiple sectors. Real consumer spending, once the engine holding the economy together, has begun to decelerate. Credit card delinquencies have risen to levels not seen since the early 2000s, and higher borrowing costs continue to suffocate household budgets. These data points collectively signal that the economy is losing strength faster than anticipated. Yet inflation pressures persist. Core price growth remains above the Fed's target, shelter costs continue to climb, and services inflation refuses to break. If the Fed cuts rates prematurely, it risks triggering a second inflation wave, one potentially harder to control than the first. If it keeps rates elevated, the slowing job market could deteriorate further, tightening financial conditions and increasing the risk of a recession. It's a lose-lose equation with no clean exit. This trap links directly to the earlier sections. QT has ended, liquidity is fragile, and the monetary system cannot absorb both restrictive rates and shrinking reserves at the same time. Maintaining high rates strains credit channels and suppresses economic activity, while lowering rates threatens to reignite the inflationary aftershocks of the last liquidity expansion. The December meeting becomes the moment where these opposing forces collide in plain view. The Fed is cornered by its own toolkit. Every option now carries a cost. Holding tight risks accelerating economic weakness. Easing risks undermining price stability. In either direction, the foundation of the current monetary structure becomes more unstable, pushing the system closer to another major shift in how money, credit, and financial stability are managed in the United States. The pressure created by rising unemployment, stubborn inflation, and stalled QT becomes even more severe when viewed through the lens of the U.S. Treasury market. This is the backbone of global finance, the place where America borrows to fund everything from government operations to past commitments. And right now, that market is showing fractures that cannot be ignored. What's emerging is not just a demand problem, but a structural funding gap with implications far beyond interest rates or inflation. Foreign demand for U.S. Treasuries has been steadily weakening. Major holders, Japan, China, and several emerging economies have reduced their net purchases over the past year. China alone has trimmed its holdings by over $100 billion as it shifts focus toward its own currency stability. Other regions facing currency pressure and geopolitical uncertainty are doing the same. This exodus is happening precisely while the U.S. is issuing historic volumes of new debt to cover expanding deficits. When fewer buyers show up as supply accelerates, yields rise sharply, not because the economy is strong, but because financing the government becomes more expensive. At the same time, domestic financial institutions are constrained by higher rates and tighter liquidity. Banks already hold significant amounts of long-duration treasuries that lost value during the tightening cycle, limiting their appetite for additional exposure. Pension funds and insurers face similar constraints. As a result, a widening gap has formed between the amount of new debt hitting the market and the amount of capital willing or able to absorb it. This imbalance ties directly back to the previous sections. A fragile consumer, a weakening job market, stalled QT, and the threat of renewed easing all intersect here. The bond market is the point where monetary policy and government financing collide. If Treasury demand continues to fall while issuance increases, the system risks a disorderly rise in yields, one that could destabilize everything from mortgage rates to corporate borrowing costs. In such an environment, the Federal Reserve becomes the buyer of last resort. Not because it wants to intervene, but because failing to do so could trigger funding stress, liquidity shortages, and a cascading loss of confidence in public debt. The emerging bond market strain is not a theoretical risk. It is a sign that the financial system is approaching another inflection point, one where stability may require actions that reshape the direction of monetary policy once again. The bond market stress doesn't exist in isolation. It pushes pressure directly into the bloodstream of the financial system, liquidity. And right now, the early warning indicators are flashing in places most Americans never see. Beneath stable headlines, the gears of day-to-day funding are grinding more heavily, revealing how little margin remains. When liquidity weakens, markets don't crumble instantly. They tighten silently until a single shock forces everything into the open. One of the clearest signs is the decline in bank reserve balances. After years of tightening, reserves have fallen toward levels that historically trigger instability in short-term funding markets. Large banks may appear well-capitalized, but reserves across the system have thinned enough that small distortions can create outsized stress. Regional banks, already hit by the impact of higher interest rates on their securities portfolios, face additional strain as they compete for deposits while funding costs rise. This undercurrent of pressure is rarely discussed, yet it forms the foundation of system-wide liquidity health. Trouble is also evident in the repo market, the overnight lending arena that keeps the financial system functioning. Recent surges in repo rates during periods of heavy Treasury issuance indicate that cash is becoming tighter. Even small spikes matter. In September 2019, a similar pattern caused overnight repo rates to jump above 10%, forcing the Fed to intervene urgently. While today's conditions haven't reached that extreme, the signals are pointing in the same direction. Too much collateral, not enough cash. Money market funds are absorbing enormous volumes of short-term government debt, but even they have limits. With yields rising and liquidity demands increasing, these funds have been pulling cash away from banks, unintentionally draining reserves further. Reverse repo balances, once above $2 trillion, have collapsed to near zero, removing a critical buffer that helped stabilize markets during the tightening cycle. This emerging liquidity tension directly follows the stresses in the bond market. As foreign buyers retreat and Treasury supply expands, more collateral floods the system. But without sufficient cash to absorb it, the imbalance spills into repo markets, money markets, and bank reserves simultaneously. These are not separate events. They are interconnected signals pointing to a system stretched thin. When liquidity dries up, the risk isn't just higher volatility. It's the possibility of a sudden funding freeze, where markets struggle to roll over debt, institutions scramble for cash, and the central bank is forced to intervene. The quiet strain building now is the same kind of pressure that has preceded every major financial disruption of the past 2 decades. As liquidity tightens, bond yields climb, and financial markets strain, the most important pillar of the economy is weakening at the exact same time: the American consumer. Unlike market data that moves quietly behind the scenes, the slowdown in household financial health is now showing up everywhere, from rising delinquencies to shrinking savings. And once the consumer falters, the entire economic structure begins to lose momentum from the bottom up. Household budgets are being pushed to extremes. Credit card balances have surged past $1.3 trillion, the highest level in history, while average interest rates have climbed above 22%. These are not temporary pressures. They're structural fractures. Auto loan delinquencies are rising at the fastest pace in more than a decade, and mortgage affordability has collapsed to its worst point since the early 1980s. Rent consumes a record share of income in major cities, and essential costs, insurance, utilities, groceries, continue rising even as wage growth cools. Savings buffers that once cushioned families have nearly evaporated. Excess savings accumulated during the pandemic are gone, and the personal savings rate has fallen to levels that mirror pre-recession patterns. The cushion that kept consumer spending afloat in 2021 and 2022 is no longer present. That shift is now reflected in retail sales softening, discretionary spending pulling back, and major companies reporting weaker demand across critical sectors. These pressures connect directly to the liquidity and bond market strains highlighted earlier. Higher yields lift borrowing costs across the economy, feeding directly into credit card APRs, auto loans, and business financing. When banks face reserve pressures, lending tightens, making credit harder to access. Consumers already stretched thin become more vulnerable as financial conditions restrict their ability to manage rising costs. Employment trends add another layer of concern. Unemployment has risen, job openings have declined significantly, and wage growth is losing momentum. While headline numbers still appear stable, the underlying trend reveals weakening labor demand and growing stress in industries sensitive to interest rates. A softening consumer paired with slowing job creation forms a feedback loop. Reduced spending weakens businesses, and weaker businesses slow hiring. The slowdown is no longer theoretical. It is visible in data and lived in real time. America's economic engine is not stalling from the top of the financial system. It is grinding from the ground level, where households face tightening conditions with fewer tools to adapt. This is the stage where monetary policy meets reality, and the strain shifts from markets into daily life. With consumers weakening, liquidity thinning, and the bond market struggling to absorb historic Treasury supply, the pressure on the Federal Reserve intensifies. At some point, the system will demand relief. Not because conditions are comfortable, but because the machinery of credit, debt issuance, and market functioning can no longer operate under tightening constraints. And when that moment arrives, the return of quantitative easing will not be framed as a choice, It will be framed as a necessity. But the consequences of restarting QE carry a dual shock that reshapes the economy in profoundly different ways for different groups of Americans. The first shock hits financial markets. When the Fed begins purchasing treasuries and mortgage securities again, liquidity will surge back into the system. Banks will see their reserve balances rise, funding markets will stabilize, and borrowing costs will edge lower. This relief acts like adrenaline. Stock markets respond instantly, real estate valuations rebound, corporate credit loosens, and speculative appetite returns. During the last QE cycle between 2020 and 2021, major indices climbed more than 80%, and home prices rose at their fastest pace in modern history. The mechanism that lifts asset values is structural: more reserves, more lending power, more market liquidity. But the second shock unfolds quietly and hits households long after the initial celebration. Newly created liquidity expands the supply of dollars circulating in the economy. And even if the Fed avoids extreme stimulus, the value of each dollar begins to erode. This is not theory, it is arithmetic. As the money supply expanded by trillions during the pandemic, inflation surged to 9.1%, and real purchasing power fell at its fastest pace in 40 years. A renewed round of QE risks reactivating those pressures, especially when the underlying issues, high housing costs, rising insurance premiums, energy instability, and supply bottlenecks, remain unresolved. This dual shock connects directly to the prior chapter. A strained consumer combined with rising prices becomes a dangerous combination. Asset owners recover, but wage earners fall further behind. Households already struggling with rising credit card APRs, elevated rent, and shrinking savings face even more difficulty as the real cost of essentials climbs above income growth. QE lifts markets, but it simultaneously compresses living standards for those without significant assets. This divergence is the hidden reset embedded in every liquidity expansion. It redefines who becomes wealthier and who becomes economically vulnerable. The financial system stabilizes, but everyday life becomes more expensive. And as QE returns in a world already strained by inflationary aftershocks, the separation between market performance and household reality will grow sharper than anything witnessed in the past decade. The return of QE does more than stabilize markets or revive lending. It accelerates a deeper transformation already underway in the global monetary order. For decades, the US dollar dominated international trade, foreign reserves, and global finance. But structural shifts are now converging. Strained domestic liquidity, rising geopolitical tensions, and the growing reliance on unconventional monetary tools. Together, they point toward an emerging currency reset, one not defined by a single moment, but by a series of changes that quietly alter how money functions both inside and outside the United States. A key pressure point is the dollar's declining share of global reserves. Over the past decade, its portion has fallen from above 70% to near 58%, marking a steady erosion of dominance. Nations seeking insulation from U.S. financial influence, particularly adversaries and large commodity producers, have accelerated diversification efforts. Whether through gold accumulation, bilateral trade agreements, or alternative settlement systems, major economies are slowly reducing reliance on the dollar-centric framework that defined the post-World War II era. At the same time, new monetary tools are emerging. Treasury-backed stablecoins are carving out a role in global finance, circulating billions of dollars in digital form outside traditional banking channels. Central bank digital currencies are under development across dozens of nations, reshaping how transactions clear and settle. Even within the U.S., early infrastructure discussions hint at future systems that could allow the government and the Federal Reserve to distribute digital dollars directly, bypassing traditional intermediaries. These innovations do not replace the dollar, but they change how it is issued, transmitted, and controlled. These shifts connect directly to the earlier sections. When liquidity thins, QE returns, and domestic pressure rises, the value of the currency is altered not by decree, but by design. A weaker dollar becomes a byproduct of the tools used to stabilize the system. Higher deficit spending pulls the currency downward. Liquidity injections reduce its purchasing power. Global alternatives reduce its dominance. The reset unfolds slowly, but with compounding force. This transition does not resemble past monetary shocks. It is not a collapse nor a sudden abandonment. It is a gradual restructuring, one where the dollar remains central but no longer uncontested, no longer static, and no longer insulated from the consequences of domestic financial engineering. A new monetary era is approaching, and by the time the world recognizes the shift, the reset will already be underway.